The key to thriving in multifamily investing isn't just understanding market cycles, but it's knowing how to turn every phase into an opportunity. Hey, Small Axe community, it's your boy Nico. This show is dedicated to helping you use your small axe to build a personal empire. So, on this show, I'm going to share some real, raw, behind the scenes info that's going to help you build your own multifamily portfolio. So if you enjoy this show, I would love it if you could share it with somebody that you think could get value from it and write a review. It's the only way that we can grow this thing. Now let's get to work. Let's jump into this episode and start sharpening those axes. All right, guys. So today's podcast is going to be about talking about market cycles. Now, I am not a pro, okay, on market cycles because I have not lived through or invested through various market cycles, but I am experienced enough to talk about my knowledge and what I have witnessed and what I have experienced personally, as well as what my colleagues, friends, and mentors have experienced through market cycles. Let's jump into this, guys. And this topic came to me because of the fact that we are considering listing one of our properties, right? And we bought it at the peak of the market, 2022, which I am considering the peak. It's maybe 21, 22. I don't know, maybe a little bleeding into 23, but most likely it was 22, which was the peak of the market, meaning prices were highest. So how is this an issue? Well, let's take a look at it. 2-3 years later, after the peak, prices have gone down. Now, why is that? In commercial real estate, we typically just say we have more control of commercial multifamily real estate than single family real estate. We have more control because we can push the NOI. We can force appreciation. However, something that the gurus don't always talk about is cap rate decompression, cap rate expansion, and how cap rates change. We know that a property's value, or let's take it like this. If we have an NOI of a property, my simple example is an NOI of $300,000, meaning gross scheduled rents are maybe $600,000 minus vacancy, minus delinquency, plus adding in other income, then subtracting all of our expenses. So it's basically income minus expenses gets our NOI before debt service. So income is going to be rents plus other income, less vacancy and delinquency and concessions. Then expenses are going to be taxes, insurance, contract services, legal fees, utilities, property management fees, unit turn costs, property, landscaping or lawn care, repairs and maintenance, maybe advertising, maybe some administration fees, etc. So those are the expenses. Now, income minus expenses gets you your NOI, and then there's debt service. So if your debt service is not covering your NOI, you're in trouble, but we're not talking about that today. Income minus expenses gets NOI. So let's assume we have a $300,000 NOI. Let's say we bought a property 2022, the peak of the market, $300,000 in NOI. Now, flash 2 years later, that same $300,000 in NOI is fine. You're cash flowing the same amount. Everything's good and rosy. However, if you go to sell the property, there might be a clear difference in what you can get for it. And let's talk about that real quick. $300,000 in NOI valued at a 5% cap rate 2 years ago, where the market was strong and people were eager to invest, would be valued at $6 million. So let's say our building is valued at $6 million 2 years ago, and that's what we paid for it. Now everything's staying the same. Rents are the same. Expenses are the same. We still have the same $300,000 in NOI 2 years later, and we go to sell it or refinance it. Now the value is going to be at a 6.5 cap. We didn't do anything different to the building. We didn't change operations, do anything, but the 6.5 cap is based on buyer's sentiment. So when people say you can force appreciation, they're right. They're right. Absolutely. You have to also account for market cycles. And in market cycles, buyers become more aggressive and less aggressive depending on what is happening in the external environment or at the market at large or the economy. So in today's environment, that same exact property of a C-class property, 1970s build, is now valued at a 6.5 cap rather than a 5 cap. So a 6.5 cap rate with $300,000 in NOI is only a valuation of $4.6 million. We just lost $1.4 million in value over the course of 2 years at that same exact operations figure. So yes, you can force appreciation and increase the NOI to $400,000 or $500,000, but during a trough or a down cycle in a market cycle, you have to be weary and understand that the cap rate is also going to drive a huge amount of your valuation if you're looking to sell or refinance. Now, a completely different story. You can survive multiple cycles of market cycles, like ups and downs and troughs and peaks. You can survive them as long as you don't need to sell or refinance and as long as you're cash flowing. Let's just talk briefly about the different types or the different parts of a cycle. So right now, I am saying we are in contraction. So there's expansion, there's peak, there's contraction and trough. Expansion is a growing market, and it could be market specific or the market over the US in general. It could be localized market as well as generalized market. Expansion, peak is at the top where things are valued the most, meaning the cap rates have compressed the most. I saw things trading at 3.5 caps for an A-class property. Then there's contraction. Things start slowing down, and that's where we're in today, unless we have already hit a trough. I don't think we have hit a trough, which is the bottom of the market, which would then lead into an expansion again. I don't think we've hit the trough. I think we are in a down cycle or a contraction. So things are changing. Rents are not being, you can't push rents in many markets right now because people can't afford the rents or they have so many options to choose from. It was a whirlwind of things that took place. For example, because of the low interest rate environment a few years ago, a lot of new construction came online, which provided too much housing for people or gave people too many options, along with the fact that many jobs are being lost or wages are not rising. So with all of those factors, people are not willing or cannot pay more in rent. So rent is flat and or declining. It is increasing in some areas, and we're actually able to increase now today, but that's actually a very localized thing because we're only able to increase rents today because of the fact that many people were displaced in the local area from hurricanes. That's not the factor everywhere. So we are lucky in that sense for hurricanes. Typically, hurricanes are not a lucky thing at all, but we are lucky in that sense. So in this time of a contraction, you have to just ensure. Actually, I'm going to backtrack on that. In every part of the market cycle, you have to ensure you are cash flowing because that gives you leverage to fight against any market cycle. If you are cash flowing in a contraction, in a trough, you don't need to sell the property unless there's some crazy event that happens, some terrible situation with you and your partners, or your loan comes due and then you're in trouble. So it's also important to understand that through these cycles, if you are cash flowing, you're in a fine position. If you have to sell, do a forced sale or refinance due to broken partnerships, legal matters, or a loan coming due, you could be in trouble. Let's go back to that example. A $300,000 value NOI valued at a 5 cap is $6 million. $300,000 NOI today value at a 6.5 cap is a $4.6 million valuations. If you are cash flowing and surviving today, there is no point to sell because you would sell at a loss. Unless, of course, you can prove a pro forma of future valuation of what somebody can come in and do to the property. And that's always possible as well, but you cannot count on that. So it's extremely important to understand market cycles, especially when you're getting debt, because you don't want your debt to come due during a contraction or a trough, even worse. In those scenarios, you're forced to sell the property and you don't want to be forced to do anything. So The key takeaway with all of this is to understand that you should plan out your exit strategy from the beginning, and you should always go into a property that is cash flowing, just in case you hit a trough, just in case you hit contraction, just in case there is expansion, but you have to sell within the next year and the expansion is not going to be enough upside to provide you that value. So you have to understand that your property should be cash flowing day one, no matter what cycle you're getting into. Now, if you're going into the peak, you want to get fixed rate debt. Why? Very simple, because for the next few years, if the market is contracting and going into a trough and then finally expanding again, could be 3 to 5 years before you see that peak again, or maybe even 7 years. So you want to get longer term debt. Now, let's say you're going into a trough. Like maybe we're contracting today we're in a contraction. Maybe we're at the trough. I don't think so. Like I said before, let's say now we're going to buy a property. I would probably have at least 3 years of debt. So I don't want the debt to come due in 1 year, and I don't want the debt to come due in 10 years, because I'm going to have an opportunity to sell or refinance in 3 to 5 years max from today. So these are all things that you need to consider and how you can excel or win in any market. Now I'm going to turn this on to you. Are you looking at a deal today? Hopefully, yes, because we should always be looking at deals. Never want to be pencils down, as other people claim they were or were at some point. Do not be pencils down. Always be looking. Look for a deal that cash flows today. Now consider your debt. You found a property that's cash flowing. Don't go in there and get a fixed 10-year rate, Fannie Freddie, let's say, because you're going to have a very hefty prepayment penalty through defeasance or yield maintenance. You might want to consider a step down, maybe a 3-2-1 prepayment penalty, because that'll give you 3 years to stabilize a property and potentially hit the peak to refinance out. We can assume that if market cycles are 5, 7, or 10 years, maybe I think it's about 7 years max for a market cycle. The last cycle was a little bit unusual historically. If we consider 5 years, each market cycle is 5 years, we're hitting the down cycle in about a year, let's say. You want to get debt today that is going to be equivalent to you taking the opportunity to cash out, refinance, or sell at the peak. Let's assume the trough is today. Within 5 to 7 years, you are going to be able to, you're going to be at the peak and you're going to want to get out. Some people don't want to time the peak because obviously it's nearly impossible to time when the trough is, when the peak is. It's just the only really way to time it is, or to guess when it's going to happen, is when you look over your shoulder behind you and you've seen that it's passed. That's Bill Ham's saying, by the way. And that's the truth. So you can't really time it. But if you're feeling things are hot, the cap rates are compressing, meaning getting smaller. People are willing, the buyer's appetite is strong. People are willing to pay more money. Maybe now is the time to refinance. And that's going to happen in a few years. It's not going to happen today. So let's say you have your cash flowing property today. You're going to choose debt on it. I would get at least 3 years fixed before you have any decisions. I would prefer to have 5 to 7 to 10 years fixed with a very low prepayment penalty. Years, maybe a 3-2-1 step down, so that year 3, you have the opportunity to exit in some form of fashion if you want, because the market should be hotter in 3 years from now. Okay. Let's say you have a property that you bought in 2020, debt is coming, or 2019, and debt is coming due early next year. You are now in trouble because you bought it in a hot market. Maybe it was cash flowing. You're doing fine. You didn't want to sell. You didn't want to refinance in 2022. The rates were low. You missed the opportunity. You thought it was going to get better. You missed the peak. Now you're screwed, right? So what are you going to do? Instead of just taking a loss, if that same scenario of the $300,000 NOI was valued at $1.4 million more in 2019, instead of taking that loss, now you're going to have to force the NOI. So you have options here. How are you going to force the NOI? You're going to have to talk to a broker if you don't know what the market is looking for, what potential buyers are looking for. You're going to have to seek mentors and other ways, and read books and listen to podcasts and understand and learn, educate yourself how to force that NOI. Some key factors are increasing rents. Obviously, if you can increase the rents and reduce expenses, the broad picture, that makes your life a lot easier. How do you increase rents? Well, maybe you have some upgrades. If you can renovate 10% of the units, let's say you have a 30-unit apartment building, you renovate 3 units with a very high standard of renovation. Maybe you got granite granite countertops, something like that. Maybe you put washer dryers in the units, and now you can command $300 more per month than the other units. That is a very good case study for the next buyer. And you don't have to do any more than that. That is your pro forma. That is your case study to prove proof of concept for the next buyer. That's one way. Another way is to offer concessions, which are not great, because if I'm looking at a rent roll and I see a lot of concessions, I know that these renters perhaps cannot pay that or afford that. Another way to increase revenue is to implement a utility bill back system, maybe RUBS or utility bill back, put the utilities back on the residents. Another way to increase income is to have laundry income, have other ancillary income like pet fees and pet rent, and perhaps even doing some sort of bulk internet program, maybe having vending machines, maybe adding units if possible, maybe adding other amenities that would attract and command a higher price point than your competitors, et cetera. So those are ways to increase the income. Now let's talk about reducing expenses. To reduce expenses, maybe you can hire an on-site maintenance person. Maybe you can go to the local municipality and request some sort of tax cuts or abatement. And the way to do that is you would have to partner with them and provide some sort of community service or community value, which is possible. I haven't been successful in doing it myself. Another way to reduce expenses through maintenance costs would perhaps be to put some of that responsibility back on the tenants by having specific agreements written into your lease saying that they have to pay for X, Y, and Z when X, Y, and Z happens. Maybe you can reduce your expenses by reducing your management fee if you can negotiate with your management team or take your management in-house. Maybe you can reduce expenses through insurance by either carrying your own insurance if your bank will permit you to do so, and excluding certain things like wind insurance if you're comfortable doing that, or just shopping insurance around to find the best rates and increasing your deductible if you're comfortable doing that as well. Okay, those are just some simple examples. But I think the point of today is to understand that there are ups and downs in a market, layman's terms. Things go up and things go down. During that time period, you have to ensure that your property is cash flowing enough to where you're not going to be at risk of foreclosing, meaning you can pay your debt service and still have money left over to put in the bank for future issues like CapEx issues, or just to put in your pocket. And to put in your pocket rather, not or. We have to understand that when we get our debt, if we are getting a loan on a property, we have to understand when that loan is going to come due. Try to predict more or less if we're going to be in expansion, contraction, peak or trough, okay? And what our prepayment will be like at that time, okay? So all of these things need to be accounted for and factored in. Now, let's just recap. What is an expansion? This is when there's strong economic growth, increasing demand, rising rents, and new construction, which we have just witnessed. And then we hit the peak, which is the market overheats and high prices and competition signaling a slowdown that just passed us. Now contraction or recession. Reduced demand, which we're seeing now. Rising vacancies, seeing now. Declining property values, absolutely seeing now. And then the trough. The market bottoms out, creating opportunities for savvy investors like you to go out there and get the next deal under contract that cash flows with good debt and get ready for that expansion. Okay, team, somebody in this podcast episode loves you, and that somebody is me. I want you to succeed. I want you to kick butt. Go crush the world. Love you. All right, and that's a wrap, Small Axe community. So I wanted to take a minute to say thank you so much for listening to the show. And if you liked it or got any value from it, it would really mean the world to me if you would share it with someone else and write a review. Remember, guys, keep sharpening those axes. Let's get out there. Let's crush it. Love you guys.